What is going on, traders? Welcome back to a brand new video. And in this video, I'm going to simplify trading for you guys. All right. I promise you, I'm going to simplify trading for you guys. Because if you understand trading, you understand that trading is, I would say, 90% psychological, to be honest. 90% psychological. But yet, people put most of their focus into technicals. People tend to overcomplicate technicals. Why are you overcomplicating technicals if psychology is 90% of trading? So here's what I'm going to do for you guys. I'm going to show you guys the simplified version of Wyckoff. All right. So instead of memorizing, let me show you. Instead of memorizing all this PSY, this BC, this UT, this LPSY, this SOW, I'm going to simplify it. All right. Because as I told you guys, trading is 90% psychological. If trading is 90% psychological, why are 90% of trading, why are 90% of traders putting their focus on technicals? All right. So this is what I'm going to teach you guys. I'm going to teach you guys the MLBM strategy. What does MLBM stand for? Let's first talk about that. What is MLBM? Now I have a video exclusively on MLBM on my channel. I think it's called "Oh, You'll Never Look at Wyckoff the Same After This." You can go ahead and watch that video. I would recommend you watch that video before you watch this, and then come back to this after you watch that video. But it doesn't matter. Just stay tuned with this video. I'm going to show you guys. I'm going to explain everything to you guys in depth. All right. What is MLBM? MLBM. Now, the first M stands for manipulation. All right. That is the market. That's what the market does, right? The market manipulates because why? It doesn't want people to make money. It's the case. It's a competition. Let's be real. The market is a competition. It's player against player. It's banks against retail traders, whatever the case is. Whether you trade smart money, whether you trade support resistance, you are a retail trader. If you're not trading for a hedge fund or a bank, you are a retail trader. These smart money traders tend to get that confused. They think because they trade smart money, they're not retail traders. You are a retail trader, my friend. All right. Male, female, you trade $100,000 of your own personal account. You trade $5,000 of your own personal account. You trade $100 of your own personal account. Whether you trade smart money, retail, you are a retail trader. All right. The second letter of this strategy is going to be liquidation. Liquidation. The third is going to be break of structure. And the last is going to be mitigation. Let me explain these in depth for you guys. What is MLBM? Manipulation happens when price is at a standstill. All right, you can call it a stalemate, you can call it a standstill, but price has no clean structure. So price goes from doing this to doing this now. There's no clean structure. Even though the trend is bullish, there's no clean structure at the moment. This is what's happening. Manipulation is happening in between here. This is where manipulation is happening. Now, the liquidation, you can see that price doesn't simply do this all the time, right? Sometimes you'll see a low, and then that low get taken out. Phew. Price is liquidating. Price is liquidating, constantly liquidating. This is how banks take your money. This is how people are competing against other people because they see where your stop loss is. And then what do? They aim towards your stop loss. This is what they do. Sometimes you'll see, I don't know if you've ever been in the markets, if you ever trade the markets, this has for sure happened to you. If you have ever placed a trade, this 100% has happened to you. If this hasn't happened to you, it's because you haven't been trading long enough. But you'll see something like this happen. You'll see you're in profit, right? Price liquidate you out, price take you out of the market, hits your stop loss, and then it continues in the direction you anticipated and hits your take profit. But the thing is, you got stopped out. I am sure this has happened to every single one of you watching this video. If you haven't, as I said, it's because you haven't been trading long enough. It is because price is liquidating. The market is liquidating traders out of the market. That's how it makes its money. Now, the third is going to be break of structure. Simple. You have a high, we break structure to the upside, or we continue structure. You can call this continuation of structure, but I'm going to call it break of structure because it flows better. Break of structure. So we have some high, we break structure, and they continue to break structure to the upside. That is the break of structure. It's simple. There's nothing to it. All right. I'm going to simplify this. I don't want to make this complicated at all. Now, mitigation. I made a video on mitigation specifically on my channel. Again, if you want to, you can check that video out. It's called order blocks and mitigation to order blocks, something like that. If you search it up on my channel, you'll find it. But the entire point of mitigation is for the banks to close out their positions. So the banks are constantly hedging the market. So that means they're in a buy and a sell at the same time. Let me try to make this descriptive for you guys. So they are in a buy and a sell at the same time. Let's say the bank opens up a buy position right here. All right, let me move this over here. Let's say the bank opens up a buy position right here and then decides to sell the market up here. This is what hedging means. You're in a buy and a sell at the same time. So let's say the bank, right now, the bank is in one position. The bank is in a buy. So they enter the market. They're in profit, right? They're in profit. So what the bank is going to do, is do something like this. They're going to enter into a second position for a sell. All right. They're going to enter in a second position for a sell. All right. They enter into here. So they're in two positions. They're in a buy and a sell on any currency pair or commodity or whatever it is, in any indice. So they're in two positions at once. Now, what the bank is going to do, this is what the bank is going to do. The reason they're in two positions at once is to be able to move the market because they have the big money. They are able to move the market wherever they want to. So the only way to move the market is for them to be in multiple positions at the same time. Now, if you could move the market wherever you want to, would you ever lose? Would you ever want to lose? Absolutely not. So this buy position right here is simply to take these sellers out of the market over here. Simply to take these sellers out of the market. Now, in order for them to push the market down, they have to sell the market. So what they're going to do is they're in a buy position. Their long-term bias is a buy position. Their short-term is a sell. In order to push the market down, they have to sell the market. So the market comes down. And then what do? They move their stops to break even. They move their sells to break even. They move their sells to break even. The reason they do that is because, again, as I told you, the long-term bias is buys, but they move their stops to break even on here, and they come back to this position to mitigate, to close out their orders. All right. So they come back here to close out their orders, to close out some of the buys. And what happens? They push price up. They continue to push price up. So this is already at break even. They are closing out their orders. They are mitigating. In order for them to mitigate, they have to sell the market back down in a buy scenario. In order for them to mitigate, they have to sell the market back down in order to buy it back up, to have the money to buy it back up again. So this is what happens. This is just a general idea of what happens with the mitigation of price. All right, so with that being said, let me show you guys a live example of the MLBM strategy. I have an example right here, actually. If you look at this, look what is happening. All right. Now, a lot of people will revert to Wyckoff and, oh, this is accumulation. You've got the PS. Where's the PS? You've got the PS, one of these, the PS, then the SC, then the ST, then the AR, then the all right, listen up. Let me simplify this for you guys. Let me simplify this. So, in simple terms, all we have is manipulation happening within here. Manipulation is happening within here. That is the first step to Wyckoff. Is to address the manipulation. Is to understand the manipulation. That manipulation is happening. All right, that's the first thing to understand. Next, liquidation. Look, you had a low right here. What happened? That low got liquidated. It got taken out. All right. Then you had some lows right here. They got taken out, and the market is constantly liquidating within the manipulation, within our manipulation range. All right. Now, how can we capitalize on the MLBM? How can we capitalize on the market when it's quote unquote Wyckoff? All right. This is a simplified version. As you see, price starts to manipulate, liquidate, but at the same time, structure is being broken to the upside. So if we're anticipating buys, we want to see structure being broken to the upside. You can see this structure high got broken. This structure high got broken. And even though price came back to this zone right here, we can see this low right here still holding. We can see some structure being held. All right. Now what happens? We can see that this low right here got taken out. This last low got taken out. And what happens? This is the high. What happens after it gets taken out? Price breaks to the upside. Now, what can we do? We can expect mitigation now. So we had the break of structure, which is right here. Let me actually zoom in, make this easier on your eyes. We had the break of structure that occurred right after price broke this line. And then what happens? You get the mitigation. So the optimal mitigation would be this line right here. If you want to get into the market right there, you can. But just remember, stop loss is going to be below the low that liquidated the previous low. Optimal entry would be up here, as I said. But if you want to refine your entry, you can get in on the order block. And if you want to scout out on lower time frames, find any unmitigated order blocks there, you can do so. All right. So again, as I told you, the market makers have to sell the market. They're at break even at this point, and then what happens? They push the market up, and let's see where price goes. They push the market up, and then what do you get? You get the continuation of price. Look how beautiful that is. Look how beautiful the delivery is. Look how beautiful that is. So you have entered over here, and our positions are still in the market. We are just riding the wave to the upside. All right. So that is the MLBM strategy for buys. It's the same case for sells, just looking at the price from the opposite end. Same exact case for sells. Let me see if I can find one for sells really quickly before I close out this video, because I don't want this video to be too long. All right. So look at this. 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 This is actually nice right here. Right here. Beautiful. What is happening? All right, so we go from, I don't want an alert, I want to get my text. So we go from having, look at this. So we go from having clean structure to the upside, and then we get this. That tells us something, that price is going to do something significant right after this. Because price goes from having clean structure to the upside to now this. This doesn't make any sense. There's a reason price is doing this. It's because price is getting ready to make a significant move. Now, in order to capitalize on the move, you have to understand the MLBM. All right. Don't overcomplicate it with this. Don't overcomplicate it with distribution or accumulation in the previous example. In this example with distribution, don't overcomplicate it with distribution. Use MLBM instead. All right. So here's where we are. We got price. What happened? Did any liquidate? What's happening? Understand that there's manipulation happening. Realize that there is manipulation happening. All right. That's the first step. Now, is there any liquidation happening? Are there any liquidations happening? Yes. You can see a high right here got taken out. Then this high got created. That was taken out. Then this high got created. That was taken out. Now what happens? Next, look for breaks of structure. So even though these highs were taken out, you can see price breaking structure to the downside. Price breaking structure to the downside. What happens? You get this low that took out the high. Let me do this. And then what happens? You get a break of structure to the downside. So now we are right here. You get a nice break of structure to the downside. So after realizing first that this is manipulation, and then after seeing these liquidations happening, what do we want to do next? Look for the break of structure. So this got liquidated. Then we got the break of structure down here. Boom. The candle closed below the low. Now what are we looking for? All we need to do is place a sell limit, or you can market execute in this case because the market is right where you would enter anyway. So you could market execute, or you could put a sell limit from right here, stop loss right above the high, and you can TP wherever you want. You can do a 1 to 3. You can target the next support zone. You can target the next key level, whatever you want to do. What happens? We have a sell limit going on right now, and then on the very next candle, bam, we get tapped into the trade. And price delivers beautifully. Look how beautifully price delivers. Look how beautiful. Well, this is only, all you had to do was place the trade, place the buy limit, place a sell limit, place a sell limit, and let price do its thing. All right. Now, this doesn't mean that this strategy is guaranteed to work 100% of the time. Absolutely not. But from my back testing and from understanding this strategy myself, from cultivating this strategy, from cultivating the MLBM strategy myself, I have realized that this is a high win rate strategy. This is a high risk to reward strategy, excuse me. High risk to reward strategy. The win rate I haven't found out yet, but the risk to reward is insane. So that means you could lose two trades in a row, and one trade will put you in profit 3, 5%, whatever the case is, depending on how much you risk. All right, so understand this. Look how beautiful price delivered. All right, so that is the MLBM strategy, guys. Don't overcomplicate it with Wyckoff. Do not overcomplicate trading. Trading is 90% psychological. You should not be trying to overcomplicate trading with technicals. All right, it's hard enough with the psychology aspect. You don't want to overcomplicate it with technicals as well. So stray from Wyckoff, use MLBM, so you don't have to do all this labeling, all this memorizing. All you're simply doing is recognizing, seeing, and capitalizing. That's all you're doing. You are recognizing that there's manipulation happening. You are seeing the liquidations happen, and you are capitalizing on the breaks of structure and the mitigations that happen within the manipulation zone. All right, that is MLBMs for you. Instead of using Wyckoff, use MLBM, the strategy that I have created. I will see you guys in the next video. Hope you enjoyed this one. If you did, be sure to subscribe. Show some support. Be sure to subscribe. Hit the like button, and I'll see you guys in the next one. Hope you enjoyed this one.